What is going on, everybody? This is S Trades, and in today's video we're going over the one ICT concept that you must absolutely use that will make you profitable and to completely remove other ICT concepts that you know. And without further ado, let's get straight into the video. So what is this one ICT concept? As you see on my screen, it's fair value gaps, right? This is the one ICT concepts that I believe is the only thing that you truly need to become profitable, because it's such a simple and easy PDA to actually recognize, and it removes all the guessing games, for example, with breaker blocks, order blocks, rejection blocks, all the other blocks you could think of. There's a lot of discretion that comes into it. Some people, for example, use the wicks of the bodies. Some people use the closing of the bodies. Some people just mark out the whole range and use that. And there's a lot of like discretion that comes into it. With fair value gaps, you just see it and you know it's a fair value gap, and if you have it on your screen, most likely someone else will have the same exact fair value gap on their screen, because it's like it's right there in your face. And in my opinion, this is the one ICT concept that truly can make so many people profitable, because it is the core concept of how everything in the whole market works. So what is fair value gaps, right? I already made a whole in-depth dive of this concept in my bootcamp. Link is going to be in the description if you guys want to check that out. But just a quick recap of what fair value gaps are. It's pretty much just an inefficiency or imbalance in price, where we have like a 3 candlestick pattern formation, right? And the middle candlestick leaves off the bodies, and the wicks don't come intercede with each other, right? And it leaves this kind of gap in between, and that acts as a fair value gap, meaning there are some imbalance of orders that are resting in this area, because price was so volatile and so fast and displaced through whatever highs. It left this area as an imbalance or an inefficiency that later will probably come down, fill those orders in, and continue the price higher. Same thing for a bearish example, right? We have this inefficiency right here left, because you can see there are no wicks kind of interceding with each other, and there's this 3 candlestick pattern formation, right? And then this big gap left. There's no wicks or nothing like that, right? So price would tend to come into that area, retrace into it, and then start to see prices lower, right? So that's what fair value gaps is in a nutshell, right? This is literally the one and only concept that you need in order for you to become profitable, because with fair value gaps, you could use it in so many different ways. You could use it as an entry model. You could use it as a bias. You could use it as draws as liquidity. You could also use it as your stop loss, your take profit. Literally, fair value gaps, you could use it for your entire trading system. Like, that's literally all you need, right? You can't really do that with order blocks and things like that, because again, it comes down to a little bit of discretion. And I'm not saying that like order blocks, rejection blocks, breaker blocks, all those other ICT concepts do not work, but in my opinion, fair value gaps is the most highest probability PD rate that literally works the most. Not only that it works the most, but it's so easy to spot, and like there's no like argument in between, like, oh, that's not a fair value gap, oh, like this not might be a fair value gap. There's no such things. With order blocks, you could kind of see it. Some people will be like, oh no, that's not an order block, like you have to go on a higher time frame, you have to go on a lower time frame, or like, oh, you marked out the wrong wick, or you have to mark out the body. There's no such arguments with fair value gaps. Like, you see the fair value gap, you see the gap, and you know that's a fair value gap. Now, there are obviously different like tier lists of fair value gaps, so there's like high probability fair value gaps and low probability fair value gaps, which is kind of what we're going to go over later in this video. And before we get into the actual real chart examples, some of the things that you have to keep in mind when you're looking at fair value gaps is the context behind it, right? It's not that you just mark out every single fair value gap that you see, like going from 1 minute, 2 minute, 3 minute, 5 minute, 15, 30, and hourly. That's not how fair value gaps work. You have to only mark out the highest probability ones, which is the higher time frame ones, and the ones that come with context, the ones that align with the equilibrium, the ones that are discounted fair value gaps and premium if you want to look into short, right? So there are these different contexts that you have to put into play in order for these fair value gaps to be very, very high probability, right? Don't just go and sit and mark out every single fair value gap you see going from a 1 minute and so on and so forth, right? Only have the highest probability fair value gaps marked out. Taking a quick look at our first example, right? We have this massive leg that ended up happening here, right? And if you just draw the fib tool right here, you see where the equilibrium rests and things like that, right? And you see that there's a fair value gap that also lines up with the equilibrium, which is this 4-hour fair value gap right here, right? So you can mark that out. Now there's also 2 more fair value gaps in this leg, right? We have this little small fair value gap in this leg and this one over here. And as you guys could see, although price did end up coming down here, we did see prices higher, but this is still not the highest probability. You could though use this as a tool. You could use this as a PD array for you to go long, but when we have like PD arrays that are, when we have fair value gaps lined up with the equilibrium, this is the most highest probability setups that you could take. And now if we just take a look over at what happens, right, we have price come down here, right, we filled that 4-hour fair value gap, we tap the equilibrium, and now we start to see immediate displacement higher. And this is where you could be taking your longs, right, whatever your entry model is. It could be, I don't know, inversions, it could be CISDs, Baker structure, whatever you guys have. Once you have your entry model, you enter whatever, right, and then we see that there's also another fair value gap that ends up forming in this leg, right. So another 4-hour fair value gap that ends up forming for us, right, and we see that this another 4-hour gets filled and price ends up immediately going up higher, right. So as you guys could see, you put up these 4-hour fair value gaps together, right, we have this discounted and another 4-hour gap that got formed, right, and you start to put this context together, and we see prices ends up delivering from it. So taking a look at another example, right, like I said previously, you need to use context behind all your fair value gaps, right. So where are we currently in this market, right? We see that we had a major liquidity sweep over here on a daily time frame, right? Price ends up coming down lower, taking out this low and taking out this low over here. So now we have a liquidity sweep and we're delivering from sell side. Then what do we see? We have immediate reactions higher, right? And we see that there's a lot of displacement going up higher, pushing past this previous high over here, right? And then if you just take a look at our daily time frame, we see that there's no fair value gaps at all in this leg. So this is where you could be taking your premium entries, right, of fair value gaps, because there's nothing else in this leg over here. That is a daily time frame. And we also see that this daily fair value gap aligns with this previous high or previous all-time high that was made. So this usually acts as a retest, right? Price ends up kind of pushing past the high with displacement, and it tends to kind of come back down and retrace to that previous high. And usually when you have a fair value gap lining up with that previous high perfectly together, that is a very, very high probability. And also if we scale down on, let's say, an hourly fair value gap, right, we see that we have London low over here, right, and we have these equal lows lined up with this 1-hour fair value gap together. So we could potentially see price come down over here, acting as our inefficiency in order for price to get fueled and push up higher. So let's see what happens here. We see that price comes down here, right, fills this daily fair value gap fully, right, takes out this London low, takes out these equal lows that's also aligned with the fair value 1-hour fair value gap, right. And now we start to see that price immediately pushes up higher and continues on with a lot of displacements, right. So we see price ends up absolutely going higher, right. We also see another fair value gap get filled over here, right. There's a 4-hour fair value gap that gets tapped into over here, and price ends up pushing past higher. You go down on smaller time frames, right, there's also this tiny 1-hour fair value gap that got traded into. That's a discounted 1-hour fair value gap, right. We start to push up higher, right. So we are now not only delivering from this sell side over here, right. So we had a very, very major liquidity sweep and a lot of displacement. We came back down to this daily fair value gap over here that got tested with the previous all-time highs. Now we're kind of starting to build up more and more context for our bullish bias, right. So not only did we trade into this 4-hour, we also traded into this 1-hour fair value gap, and we see as we get more displacement, as we get these little inversions over here, right, so price ends up closing above bearish fair value gaps, right. So now we're using the context of all these trades, right, so price ends up closing above it and pushing past higher. And now we see that there's another discounted, very, very discounted fair value gap in this leg, right. So if we draw our fib, we see that there's another 1-hour fair value gap over here in this leg. And if you want to be even more accurate, you come down on lower time frames. So if you come down on a 15-minute time frame, we see that there's another very, very discounted 15-minute fair value gap in this leg, right. So not only that we tapped into this discounted 1-hour fair value gap, if you come down lower, we start to see that there's another 15-minute fair value gap, right. Also, we had another liquidity sweep over here for this 1 hour, right. So now you start to kind of put these things together, right. As you see these big fair value gaps, you could kind of come down into lower time frames such as 1 hour, 30-minute, 15-minute fair value gaps and see if they're also aligned with your bias. And in this case it is. So now after seeing price tap into this 1 hour and the 15-minute, we have an immediate reaction high, right? If you even scale down lower, you see that this 5-minute gets closed above, right? So that could be your entry model, and we see price ends up absolutely crushing it, going up 200 points, right? So, all right, so taking a look at the last example, we're back on the daily time frame, right? So what do we see here? We see that there's a daily fair value gap that also aligns with this new week opening gap. If you go on a weekly time frame, you also see that there's a weekly fair value gap in this leg, right? So now we have two fair value gaps all in here, high probability. If we draw out our fib from the bottom to the top, right, this is where the displacement happened. We see that the equilibrium lines up with all of this, all these fair value gaps, right? Come down lower, right? There's a 4-hour fair value gap also lines up with this, so you could even narrow it down, right, to this 4-hour right here. So as you guys can see, that's how we're narrowing things down, right? So this 4-hour right here lines up with that previous all-time high, just like we had another example, right? And now if you go even on a lower time frame, right, for re-entries and things like that, right, we see that price tapped into this whole entire daily fair value gap. It filled this new week opening gap, and now we have another discounted 1-hour fair value gap over here, right? So you have this little accumulation happening, this AMD model that could happen, right? We kind of came down here to this 1-hour, right? If you even go down lower, we have 15-minute fair value gap over here in this leg, right? So now you could see it barely tapped into it, right? And now we have an immediate reaction up higher. We see that this 15-minute bearish fair value gap gets closed above. So now all of these different fair value gaps line up together, and let's see what happens. So we see price immediately shoots up higher, and just continues going up higher, right? So as you guys can see, we're putting multiple things together into these fair value gaps. Like, I'm not going like a random 1-minute fair value gap and just draw it randomly. I put different things together, different pieces, and use it with context, and that's pretty much how it works. You see that even here, right, after displacement through this high, we retraced again back down to this discounted 15-minute fair value gap, and then immediate reaction higher, right, closing above this 15-minute bearish fair value gap, right? So this is kind of how you use these, right? Again, if you draw another fib in this leg, right, we retrace back down to the equilibrium once again, tapped into this discounted 15-minute fair value gap, and then now we start to push up higher once again, right? So this is pretty much how you use these fair value gaps, right? There's a lot of things that go into it. It's not just random 1 minute, 2 minute, whatever. You use the higher time for fair value gaps, like weekly, daily, 4-hour. You scale down to see if there are any 1-hour, 30-minute, 15-minute fair value gaps. You see if they align with your equilibrium levels, previous highs and lows that also are in those levels, and you see if the inversions follow up after tapping into those fair value gaps that you're looking for, right? So that is pretty much it for this video, guys. Again, in my opinion, fair value gaps is the most highest probability PDA rate that you could use in ICT concepts. There's no other concept like order block or any of that I truly believe that works this good as fair value gaps do. As you guys can see, all I used was fair value gaps, and I put them together with other concepts, right? But the fair value gaps was the core concept of literally everything that I just showed you guys. So yeah, if you guys have any other questions, or if you guys are confused, you could check out the full in-depth breakdown of fair value gaps in my bootcamp video. Link is going to be in the description. And if you have any other personal questions, or you want to hop on a call or things like that, join my free Discord, also link in the description. And I will see you guys in the next video.